Back in November 2024, I published a video on my personal channel saying despite being at all-time highs, NVIDIA was still undervalued. Fast forward 20 months to now and the stock is up 60%. In this video, I want to look at whether NVIDIA represents fair value now by looking at the actual fundamentals. I'm Charles, I've been building stock market analysis tools for 8 years and I run HelloStocks.ai, whose top scoring stocks have been beating the market on average since launch. First off, everyone gets scared by this number, NVIDIA's market cap, currently over $5 trillion. But that number is meaningless without the fundamentals. Whether a stock is cheap or expensive is dependent on how much money it actually makes right now and what it's likely to make into the future. Back in 2018, the world couldn't believe that Apple had just passed a $1 trillion valuation, the first publicly traded company to do so. Many people said it was too high, but they didn't have any real basis for that claim other than 1 trillion sounded like a lot of money. What they didn't factor in is that Apple also sell a lot of very high margin mobile phones. And so just 8 years later, Apple's impossible valuation of $1 trillion now sits at $4.5 trillion. My point here is when everyone was saying Apple must be overvalued because of its high market cap, it actually represented one of the best long-term investing opportunities of the decade. So let's look at NVIDIA through the lens of its actual fundamentals. The AI earnings audit on Hello Stocks will automatically adjust the earnings per share to create a normalized EPS to add or remove certain items. One-off events like one-time taxes that won't repeat again, although here it's highlighted the stock-based compensation. That's a scheme where the employees are rewarded with the company's own stock. It's very common practice and pretty common accountancy practice to add it back into the EPS. However, in this case, I'm going to remove it because if we can judge NVIDIA's valuation through a strict lens, don't be kind to the stock, let's be cautious. Let's give it every disadvantage we can. And at the end of that, if it still comes out as fair value, well, we can have more confidence in that valuation. When we remove it, the EPS drops from 653 down to 584. That gives NVIDIA a PE ratio of 36. Now, straight off the bat, that's not a crazy high PE ratio to see for a company which has been growing as fast as NVIDIA. Palantir and Tesla's are both well over 100, which is pretty ridiculous. I don't own either of those stocks, but I do own Micron, and their PE ratio is currently around the low 40s, although I bought it much lower. Why is 36 PE not that high? Well, because the expected earnings growth is also extremely high. Here we have an average estimate from multiple market analysts that NVIDIA will grow their earnings at around about a rate of 51% per year over the next 3 to 5 years, which gives it a PEG ratio of around 0.7. For context, a PEG under 1 should represent undervaluation. 0.7 is serious undervaluation. But wait. Hold on there. There's not a chance in hell we're going to base our valuation on an earnings growth expectation as high as 51%. That would be far too bullish for me personally anyway. I found that when people make investments based on such mega assumptions as that, they're kind of the times that they get burnt. Because it only requires a tiny hiccup in growth then for the stock to collapse. So just like we were conservative with the earnings, let's be conservative with the expected earnings growth. We can see the average expected EPS growth for stocks in the wider semiconductor industry as a whole is 31%. And I know from my own research that the data center build out is expected to grow in value by at least 28% up until 2030, which is actually very close to that 31% number. So I'm going to just be super conservative and take the 28% growth rate. And for the record, I actually predict the data center build out will grow at a faster rate than 28% per year. But anyway, let's use it. Because even when we're conservative with the earnings and we're conservative with the earnings growth rate, we still get a PEG ratio of just above 1.3, very much at the lower end of fair value. In fact, that's lower than Microsoft, Amazon, and significantly lower than AMD. Do I think NVIDIA is undervalued like I did back in 2024? Probably not, actually. Right now, I would consider NVIDIA to be one of the best businesses on earth, trading at just above that line of being undervalued, right at the bottom of fair value. And there's nothing wrong with owning a great business at a fair to low valuation. My personal view is that NVIDIA still have a great future ahead, and I won't be selling any of my NVIDIA stock quite yet.